Howdy, Jacob here. Today's company we'll be reviewing on our dividend yield stock screener is Conagra Brands. Let's see what we got here. Okay, so $13.5 billion market cap. Oh, enterprise value of $21.2 billion. So funny sometimes to think about companies I've just never heard of that are over $10 billion. But Let's a little bit more. It operates as a consumer packaged goods food company in the United States, mostly operates grocery snacks, refrigerated and frozen. Okay, so good amount of net debt right there. Probably not very fast growing, if at all. But let's really just see if this dividend is stable. 4.91% yield. It's pretty solid. So they're paying out roughly 600 million, and they made 600, 700, 900.5. I mean, looks like they can afford it decently. The cash flow's been going down though, because let's see, 1.1, 1.27, 1.0 billion, and then over here 600, 700, 700. So, and their dividend's gone up. Makes sense. Nope. So anyways, I feel like this dividend could stick if we think that the earnings are going to go back to how they've looked earlier in the most recent decade, or if their free cash flow has, because on the earnings side, it actually looks like they're greater. They're making more, they have more earnings than at the beginning of the decade. It's interesting. I feel like they should be going in tandem, but there might have been something that changed their capital structure a little bit when they made this acquisition. Um, I'll definitely look into that if it's close to close to the 15% return that we're looking for, and um, I'll search through their quarterly reports to find that. All right, so $7 billion in debt. With how much they make, it's not horrendous. Let's start with some assumptions here. So the $1.40, I mean, I might just keep that. I don't want to raise that. Although, I mean, it's been even over here. We're looking at an over 50% payout ratio. So I just don't think earnings are consistent enough for me to push it up. So I might just go flat. So all right, now for revenue growth, for actual appreciation, let's see. We've got a packaging company. I would say the classic 313 because I think they're going to increase with inflation. I don't think they deserve um, any sort of premium on their price to earnings and price to free cash flow. And then let's see, 8.8, but it's been going down, and their debt interest going on their debt could be great because they have 7 billion in debt. So 1% could be 73%, could be about 210 million. That's not the biggest impact on there with $1 billion in earnings roughly. So let's say 6 and 6.5 share change. I mean, it's been very minimal. I'll just do 0.02 because I don't look like they're buying enough shares to really warrant anything more than that. But all right, so this is getting us to an estimate where it needs to drop another 46% to get to a yield that returns 15%. As for the dividend, again, I think this is a fairly promising dividend. They seem to be making earnings pretty well. It's not the best one. I mean, we've gone over ones where they're making earnings. Their payout ratio is under 50%, and they have a lot of cash on hand to cover their dividend if things go bad for a little bit. In the case that it's a single business or single earnings occur. So I don't know. I feel like to me, every company is worth looking into from a high level view. Um, and then if it gets to a price that's dumbfoundingly cheap, I think personally, if I were to go back, I mean, I would want this to, I'd almost do zero and 10. So I'm just like, I'd want to get it extremely cheap. Um, but I think right now, yeah, I'll just wait until it gets closer and then and then we'll have to reevaluate. But until then, just sitting, waiting patiently, looking at other stocks. So thank you, and I hope you have a good rest of your day.